A person opens a brokerage account. They don't want to pick individual stocks. They've heard about diversification. They type in a ticker symbol, something like an S&P 500 ETF, and click Buy. Within seconds, they own exposure to 500 companies. It feels almost too easy. No meetings with fund managers, no minimum investment requirements, no complicated paperwork, just a single trade. But behind that simplicity is one of the most important financial innovations of the past 50 years. And most investors have no idea how it actually works. Let's step back. Exchange-traded funds, ETFs, have grown from a niche product in the early 1990s to a dominant force in global markets. Today, trillions of dollars are invested in ETFs across the United States and Europe. Pension funds use them. Hedge funds use them. Retail investors use them. Even central banks have used ETF structures in certain contexts. Yet despite their popularity, many investors misunderstand what an ETF truly is. Some think it's just a cheaper mutual fund. Others believe it's simply a basket of stocks that trades like a stock. Both descriptions are partially true, but incomplete. To understand ETFs, we need to understand structure. At its core, an ETF is an investment fund that holds underlying assets, stocks, bonds, commodities, or other securities, and issues shares that trade on an exchange, just like individual company shares. If you buy a share of an S&P 500 ETF, you are not buying one company. You are buying a proportional claim on a portfolio of 500 companies held inside that fund. So far, this sounds similar to a mutual fund. But here's where the story becomes more interesting. Traditional mutual funds price once per day. You place your order during the day, but the transaction executes after the market closes at that day's net asset value, the NAV. ETFs, however, trade throughout the day. Their price fluctuates in real time based on supply and demand, just like any stock listed on the NYSE or NASDAQ. Now pause for a moment. If an ETF is holding a basket of underlying securities with a known value, and its shares trade freely on the open market, what keeps its price aligned with the value of its holdings? This is where the real mechanics begin. Behind every ETF is a creation and redemption process, an elegant system that most retail investors never see. Large financial institutions known as authorized participants, usually major banks or trading firms, play a central role. These institutions have the ability to create or redeem ETF shares directly with the ETF issuer. Let's imagine demand for a particular ETF rises sharply. Investors are buying aggressively, pushing the ETF's market price slightly above the value of its underlying assets. An authorized participant notices this discrepancy. They purchase the underlying basket of securities in the open market, exactly in the proportions the ETF holds. They then deliver that basket to the ETF issuer in exchange for newly created ETF shares. Those new shares are then sold in the market at the higher price. This process increases supply of the ETF shares, which pushes the price back down toward its net asset value. Now imagine the opposite scenario. Investors begin selling the ETF heavily. Its price drops slightly below the value of the underlying assets. An authorized participant can buy ETF shares at the discounted market price, redeem them with the issuer, receive the underlying securities, and sell those securities at their higher market value. This reduces the supply of ETF shares, pushing the price back up toward alignment. This arbitrage mechanism is the quiet engine that keeps ETFs trading close to their intrinsic value. It is not magic, it is market structure. This system has proven remarkably resilient, even during periods of stress. During the 2008 financial crisis and the 2020 pandemic shock, ETF trading volumes surged dramatically. In March 2020, certain bond ETFs traded heavily even as underlying bond markets became less liquid. Critics argued that ETFs were distorting price discovery. Supporters countered that ETFs were actually providing liquidity when underlying markets were strained. The truth is nuanced. ETFs do not eliminate risk. They redistribute how liquidity functions. Here is one common misunderstanding. Many people believe that ETFs themselves create volatility. In reality, ETFs are wrappers. They reflect the volatility of their underlying assets. When markets panic, ETF prices move because the underlying securities are repricing, or because expectations about liquidity shift. But ETFs also provide something powerful: transparency. Most ETFs disclose their holdings daily. Investors can see exactly what they own. This level of visibility contrasts with many actively managed funds that disclose holdings quarterly. Another misunderstood aspect is liquidity. When investors look at an ETF, they often check its daily trading volume. If volume appears low, they assume the ETF is illiquid. But ETF liquidity is not solely determined by how many shares trade on the exchange. It is also determined by the liquidity of the underlying assets. If an ETF tracks large-cap US stocks, which are extremely liquid, the ETF can often accommodate large trades efficiently, even if its visible trading volume seems modest, because authorized participants can create or redeem shares as needed. However, this becomes more complex when ETFs track less liquid markets, such as high-yield bonds or emerging market debt. In those cases, liquidity in the ETF may appear robust, but during extreme stress, pricing gaps can widen. This is not a flaw. It is a reflection of underlying market structure. There are risks. Tracking error can occur when an ETF's performance deviates slightly from its index due to fees or rebalancing costs. Premiums and discounts can widen temporarily during market stress. Thematic ETFs, those focused on narrow industries, can concentrate risk in ways that resemble individual stock exposure. And leveraged ETFs, which use derivatives to amplify daily returns, introduce complexity that many investors underestimate. But there are also significant opportunities. ETFs dramatically reduce the cost of diversification. Expense ratios on broad index ETFs are often a fraction of what active mutual funds charge. Lower costs compound over time. They democratized access. A retail investor in Europe can gain exposure to US equities in a single trade. A US investor can access European or emerging markets through a simple ETF. They improved tax efficiency in certain jurisdictions due to the in-kind creation and redemption process, which can reduce capital gains distributions compared to traditional mutual funds. Perhaps most importantly, ETFs changed investor behavior. Instead of constructing portfolios stock by stock, many investors now think in terms of asset allocation. US equities, European equities, bonds, emerging markets, sectors. The conversation shifted from prediction to structure. And yet, there is a broader debate unfolding. As passive investing grows, some argue that too much capital tracking indexes could reduce price discovery. Others note that active managers still set prices at the margin. The ecosystem remains dynamic. History suggests markets adapt. The key lesson is not that ETFs are superior to all alternatives. It is that structure matters. Understanding how ETFs function, how shares are created and redeemed, how arbitrage keeps prices aligned, how liquidity flows through underlying markets, allows investors to interpret volatility more calmly. When you see an ETF move sharply during a volatile session, it is not a black box malfunctioning. It is the market processing information in real time. So the next time you click buy on an ETF, remember, you are not just purchasing a ticker symbol. You are participating in a highly engineered system of institutions, arbitrage mechanisms, and global capital flows designed to keep markets efficient. The question worth reflecting on is this: do you understand the structure of what you own? Or are you simply relying on its simplicity? Because simplicity on the surface does not mean simplicity underneath. And long-term wealth is often built not just on what we buy, but on how well we understand the system that delivers it. This is Finance Guro, where we don't chase noise, we study reality.